Happy Monday, everybody. I hope you had a good weekend. Wow, another big week and some surprises to say the least, at least to many who thought that stocks only went up. Today is April 22nd, 2024, my brother's birthday. Happy birthday, Michael. And this is your Monday market update. Following Friday's selling, market looked like it was a bounce was in store on Monday. Spoiler, it was not to be. Stocks did gap higher at the open, and it looked like the retail sales report that was much stronger than expected took away some of those growth fears. Remember, there are a few pillars that this market is resting on. Belief that the Fed is going to lower rates, the growth is going to continue or at least not fall off a cliff, and that inflation is still in a downward trajectory. Retail sales may have checked one of those boxes, but the other two, not so much. Goldman and Schwab came out with strong earnings, and that was helping too. Treasury yields, though, popped higher in a new 2024 highs mid-morning, and that started the action in mega caps to the sell side. Add in geopolitics, and selling came in strong. Two major comments on the tape that pushed that. First, China talking about boosting cooperation with Iran. We see which side they line up on as if that was a question. And second, Israel talking more about the fact that there will be a retaliation for the Iranian air assault. The dollar was at 5-month highs. Gold was up. Copper was up. Overall, markets finished in the red. Dow was down 2/3 of 1%. S&P down almost 1.25%. The NASDAQ was down just over 1.75%. Stocks gapped a bit lower on Tuesday while the world waited to see what, if anything, Israel was going to do to retaliate for the Iranian attack. Big bank earnings still coming, and Morgan Stanley on the plus side and Bank of America on the downside. Globally, China specifically was mixed eco data. In the U.S., bad news was good news with housing starts slowing. The IMF did throw things off again with comments about risks of central banks cutting rates too soon. Yields up to new highs, pressuring stocks. Then Powell really made things happen. Now, if you have been listening to these videos, this is nothing new. But Powell did say that recent data shows lack of further progress on inflation. Remember, this progress will be needed before they can cut rates. So you know how markets read that comment? Yes, higher for longer. S&P tried to run for positive, but reversed again and closed near the lows. Dow closed up just under 1/4%. The S&P down about 1/4%, and the NASDAQ was down just under 1/4%. Again, stocks gapped higher on Wednesday with good consumer eco data from Europe. That was needed to offset the bad chip news. Recall that chips are the golden child. You know, buy the picks and shovels and all. Well, chip equipment giant ASML missed earnings. Not a good sign for chips. Stocks sold off for the rest of the morning, led by techs and semis. There was a strong 20-year treasury auction, but the chip sell-off was just too much, and stocks rolled over and closed near the worst levels of the day. The Dow was down a bit under 1/4%, S&P down over 0.5%, the NASDAQ down almost 1.25%. You're not imagining things. Yes, markets opened higher Thursday, then drifted lower. Sound familiar? AI hype versus weak semi earnings, and the forecasts coming from those semis, strong U.S. eco data and hawkish Fed talk. The AI hype was just not enough. As if that was not enough, Taiwan Semi put up good earnings but was cautious about the broad chip industry, specifically the exact AI chips that have been the focus this year of this year-long move that everyone says was just an insatiable need. Markets stabilized, but hawkish comments from the Fed and the ECB and the Bank of England took its toll. Then two central bankers took the air out of the room. Fed head Williams said that if data called for higher rates, the Fed could raise rates. Yes, rate hike. I think we talked about that last week. We have not been pricing that in. Add to that, the ECB and the Bank of England both said that if the Fed does not cut, their cutting may be affected, and they will have a hard time getting their 3 to 4 cuts in. Dip buyers did attempt to step in as the S&P neared that 5,000 mark, but the close was still a 2-month low. Dow was up about 0.1%. The S&P was down 1/4%. The NASDAQ was down 0.5%. And things heated up Thursday night in the Middle East, to say the least. Israel struck targets in Iran, ramping up things overnight. You immediately saw oil spike and futures drop, but as more time went on and more information came out, oil prices came back down and were actually lower on the session. I maintain that if you want to gauge what the market thinks about the Middle East conflict, just watch oil. So as time went on, Israel's strike was muted and carefully calibrated, and both Iran and Jerusalem were downplaying things. I will admit, when I went to bed Thursday night, things were not looking like they'd be downplayed for all. It was better picture by the morning. Markets actually opened higher on Friday morning. Did not see that coming. Fed head Goolsbee indicated that inflation progress had stalled, and that means that the Fed will need to be patient. More fuel for those no cuts and those in the no cuts camp. But if you're following Jeremy Siegel from Wharton, he still seems to think 2 to 3 cuts this year. I'm not in that camp. Pockets of strength in strange places like regional banks and weakness in info, technology, and the mega caps. When the final bell rang, the Dow was 0.5% higher, S&P down almost 1%, the NASDAQ down over 2%. For the week, here's how it turned out. Some damage was done. Dow was the only one positive for the week, up 0.1%. S&P 500 was down more than 3%, and the NASDAQ was off 5.5%. Your leaders on the way up were the leaders on the way down. Tesla, Micron, down almost about 12% for the week. Netflix, Autodesk, down about 10%. Advanced Micro and the general, NVIDIA, down close to 10%. This was a rough week. Remember, the market has been inflating day after day on 4 main supports. First, solid growth. Second, falling inflation. Third, pending Fed rate cuts. And fourth, AI enthusiasm. Until this changes, I still believe we'll see volatility, but we will have opportunities to invest. Last week, we saw cracks in the armor. We'll see what happens. Let's preview this coming week. Big numbers will be on Friday, but before that, we're getting to the heart of earnings season. 1/3 of the market cap of the S&P will report this week. Tesla, Meta, Microsoft, Alphabet, Boeing, ExxonMobil, T-Mobile, just to name a few. Those will be closely watched, and I'd say they'd provide some swings in the market. There is some eco data coming out, more obscure, but needs to be watched. Some of the support will be evident in the manufacturing and services PMI. We'll see jobless claims, and especially continuing claims people will watch. University of Michigan will come out Friday with the consumer sentiment number and inflation expectations. All of that will be great and important, but it'll take a backseat to Friday's PCE and core PCE. This is one of those keys that the Fed is watching closely. It's also the last major number before they will meet on April 30th and May 1st. Most estimates are no longer for a cut at this meeting. Notably absent from the schedule are Fed heads in blackout mode until after the meeting. I'll be back on Friday with a Friday planning video, but Monday and Tuesday will be blackout due to the Passover holiday. I'll be back on Wednesday with an update again, then again next Friday. Sorry for the disruption. Until Friday, have a great week.